So I'm recording as well, okay, and this is on public issues. So why it is important? Because in your final exam, there will be a take-home paper where you have to analyze an IPO, okay. So one other project, fine, and that will be the only project you'll have in your take-home, which will carry 40 marks, okay, and then 20 marks presentation, which you will be making, will be on the basis of an IPO or FPO or bonus issue, whatever. So you have to choose a topic. After that, okay, a presentation as well as the thing. So 60 marks is reserved for that. So we already have two quiz, okay, and two individual projects. So if you add them up, so that comes to about 40, 50. So that means 50 marks are remaining. So it will be basically then 10 marks will be for presentation and 40 will be for end term, okay. So you can either make a presentation on your mutual funds, which you have made individual, or you can make a group presentation on an IPO. So the choice is yours. Okay. So that I'll mention. So we talk about public issues. So so please let me in. हो गया ना सब हो गया कोई admit है तो नहीं अभी anybody who's in the online is waiting to join, so let me know. So you can do it, okay. So we are talking about classification of issues, okay. And he can join only when I admit it. अभी बस बंद करेंगे हम इसको क्योंकि those who have joined only they will be allowed. So otherwise we will keep. Okay. "19 students, I think, have joined. Maybe 17, including me, and somebody has joined twice. So, so this is whenever a company raises money, okay, because when you do business, you require capital, okay. The capital can be either a borrowed capital or you can issue shares, isn't it? So, or it can be a hybrid capital, both. Debt as well as equity, which is like preference shares or convertible debentures, those kinds of things are hybrid capital, okay. So that's a three ways of raising money. But then when you raise money through a public issue, so they can be basically either be a public issue or a rights issue or a preferential issue, okay. That means you can go to the public and offer your shares. First time when a company offers shares to the public through the stock exchange, and after that the company becomes listed on the stock exchange, that is called an IPO. Now, whenever a company wants to raise further capital after they have come to an IPO and the company's shares is already listed on the stock exchange, then it is called FPO. That's for raising further money for expanding the business. So this is for the first time, this is subsequent time, and then you can keep doing it whenever you require money, okay. Now, IPO can be a fresh issue. That means company can ask for money, okay. So whenever a company is issuing new shares, so company gets money, and that can be used for expanding. The second is offer for sale. That means the promoters, if they want to exit or they want to dilute their holding, sometimes in a startup company, some people join and they want to leave, okay. Once they have made a good kind of a return, or sometimes the promoters want to reduce their holding, so they can always offer their shares. Basically offer for sale. So in this case, the money will go to them. The money will not going to come to the company. Okay, fine. So again, for example, an LIC, IPO, which came few years back, there the government was actually offloading their shares. Okay, and they were inviting public. So that money which was collected had gone to government and not to the LIC corporation. Okay, this was basically a divestment plan by the government. So that was offer for sale. Similarly, Zomato. So many Paytm, so they have come and they have offered their own shares, okay. Some portion was fresh issue. So they collected some money and some money was, on behalf of the promoters because they were liquidating their share capital, okay. Is that clear? So then there can be a rights issue, which means if the company requires more share, Pratham, please focus here, okay. So the rights share, whenever a company need more money, so either they can go for an FPO or they have to go and ask the existing shareholders to contribute money. So that is mandatory as per the Companies Act now 2013. So if the company wants to raise money, further money, first they have to go to the existing shareholders. Okay? If the existing shareholders are not willing to give money and a special resolution has been passed in the general meeting of the company, then they are allowed to tap the market. That means they can go for an FPO or they can go for a preferential issue. So preferential issue is basically when the shares are issued to selected few. Okay? Instead of going to public, which is sometimes very expensive because the company has to conduct a road show, this is a long process. So they can only offer few people and they can pick some strategic investors on the board. Okay? Fine. So there can be a public issue, rights issue or preferential. So FPO can also be for the same thing, the fresh capital as well as offer for sale. Okay? Is it clear? So now, and we'll be discussing all this, again, so don't worry about it if you have not followed. Regulators of the public issue. How, because when you raise money from the public, there is always risk involved, okay, for the investors. So there are certain, regulators who monitor, regulate the whole process. There can be a fraud also can happen. People have companies have collected money and they have run away with the money. So there is the major, this thing is Security and Exchange Board of India, Sebi. Okay, so they are the main regulator of this thing. And then we have the Companies Act 2013. Okay, so this is another law which governs the public issue. And then we have the stock exchanges, National Stock and Bombay Stock Exchange, because the shares are getting listed there. Okay, so they will allow listing only if they meet the criteria of the stock exchanges. Okay, then RBI, Reserve Bank of India. Okay, so these are the four regulators, and we can just see them. So they can be Sebi, they can be Companies Act, and Reserve Bank of India. Okay, and just check if there anybody who's waiting. So these are the regulators. Okay, then the key regulations. So the key regulations we are going to talk about. The key regulations which cover the prescribed requirement in relation to preparation of financial information are. So these are the key regulations. Okay, we're going to talk about. First is ICDR, issued by Sebi. Okay, it's called Sebi Issue of Capital and Disclosure Requirement Regulation 2018, and in short it is called Sebi ICDR regulations. Okay, so there is a link there at the bottom, so you can just go there and just copy and download the ICDR regulations, and we will be touching a little bit from there. Otherwise, all my slides are covering that regulation. Okay, so this is the main regulation. Okay, so this is the main regulation. The Sebi controls the whole process, how the money is going to be collected, and what the companies need to do. Then we have the Sebi LODR, Listing Obligation and Disclosure Requirements, 2015, the listing regulations. That means it is normally the stock exchanges, because the money has been collected and the shares are issued and listed on the stock exchange. So there are certain compliances towards the stock exchanges. Okay, that means company needs to declare their quarterly kind of reporting. Okay, how much money they are making, what is the profit loss account. Okay, quarterly results. Okay, yearly results. So there is a time frame in which they have to announce, and then in India at least 25% of the shareholding should be with the public. If it falls below, then the companies get delisted. So we'll talk about that, and of course this is the general this thing, and the criteria gets diluted if the company becomes very big, like Reliance. So they don't have to maintain 25%, but 25% minimum shareholding should be with the public. So there are a lot of requirements which we are going to talk about in LODR. Then we have the Companies Act 2013. So we will be focusing mostly on the Sebi, ICDR and LODR, okay, and even the Companies Act wherever the reference is there. Okay, so these are basically the three piece of law which is there. Okay, so these are the ICDR regulations, and then you have the Sebi Listing Obligations and Disclosure Requirements, and the Companies Act. Okay, so these are the three statutes which governs the public issue. Okay, now the Sebi, first we are going to talk about the Sebi Issue of Capital and Disclosure Requirement Regulations 2018, and it keeps getting amended from time to time. The new amendments keep coming up. So we are going to talk about the latest one, what is applicable now. So types of issues, how a company can raise a money. First is IPO or an FPO, which we have already discussed. Second is we are going to talk about eligibility requirement. Who are eligible to raise money by way of IPO? So all the companies cannot go for an IPO. So there should be some requirement. Okay, so we are going to talk about that. Then the eligibility requirement for an FPO. Okay, so they are separate. They are almost identical. Okay, but they are separate sections because IPO may involve little more regulations because the first time the company is raising money, and FPO may require a little less diluted regulations because the company is subsequently issuing capital and they have met the initial norms. Then we have additional requirements for offer for sale. So whenever a company is offering their existing shares for sale, then there are some additional requirements. And then issue of warrants. So company can issue warrants. That means company will issue a warrant which will say that a person who holds that warrant will get shares of the company on a future date, or even a debenture on a future date. Okay, but the price of issue price of the shares or debenture will be decided there and then, and the shareholders, the prospective shareholders, they have to pay the money, some 10%, 15% upfront, okay, and balance only when they will get the shares. So we'll talk about issue of warrant. It will come in detail later on. So filing of, now normally the warrants are attached with when a person gets the shares from the company. So warrants are attached to those shares either through an IPO or an FPO, which allows the shareholders or the applicants to apply for shares in future also, okay, on a price which is decided by the company at the time of issue, okay, but they have to pay only when they are allotted the shares subsequently after some time, okay. Then draft offer document to public. So you have heard about a prospectus, okay. Whenever a company comes, they have to, with a public issue, they have to issue a prospectus. So the applicants, the people who are interested in a public issue, so they will go through the prospectus and they are going to decide about whether they want to apply for shares or not. So and this is called, at first stage is called the draft offer document. So companies cannot issue straight away, so they have to take an approval of Sebi. So before the approval of this document, it's called the draft offer document to public, and they have to issue this for the public, okay. ASBA, application supported by blocked amount. So this is one of the mechanism through which companies collect money, okay. Like earlier, long back, about maybe 10, 15, 20 years back, so we used to attach a check along with the application, where the application will go to the company, they will encash the check, and now the shares can be oversubscribed maybe 10 times, 15 times, so they have to refund the money who are not been allotted shares. So that means the whole process will take time, and sometimes the refunds are not done properly, and sometimes the person has not been allotted shares and he has not even got the refund. So to do away with that, so we have ASBA, where amount will be blocked in your account. So you have to have an amount, so that will get blocked to the extent of application which you have made. So money will not come out of your bank account till you get the shares. If you get the shares, the money will be credited to the company, and debit will be done in an account. It will get removed from your account, then money, it will go to the company. And otherwise, if you are not allotted, so the block amount will be released so that you can use your money, okay, if the shares have not been allotted. Now, of course, this has been also now done away almost. So we have now UPI, okay. So now the process is done mostly through UPI, okay. So we'll talk about that. Then all the companies are required to deposit some deposit with a stock exchange, okay, because stock exchange is going to be involved in the process of listing the company. So the stock exchange will collect some amount of deposit from all the issuers who are going to issue shares or debentures, whatever, okay. So it is applicable to a certain threshold. If you cross a certain money that you want to raise from public, then you have to pay this deposit. So we're going to talk about the whole this thing at a later point. What's the total rules regarding opening of an issue. So once you have gotten kind of approval from Sebi, then you have to open the issue, okay, and then subsequently close it after you have received all the applications. Also, we'll talk about both opening and closing, how it is monitored. Then underwriting. So you have to get an underwriter. Normally the merchant bankers, they act as underwriters, okay. So in case if the money is not received if there's a lukewarm response and they are not able to collect money, then the merchant bankers, they chip in and they contribute rest of the capital so that the issue can go through. Okay, and again basically it is what happens is generally the public, when they know the share issue has been underwritten, so it gives them the confidence because already a big merchant banker has underwritten the issue, so they think it's safe. Okay, so it's a kind of a moral or building exercise that all the shares should be first underwritten by a merchant banker. Then a minimum subscription. The company should receive at least 90% of the money which they sought for. If not, then the company has to return back the money to the shareholders, okay, or the applicant, not the shareholders, but to the applicant. So minimum subscription is there. Then oversubscription. So we are just touching, little bit all the bullet points, and then we'll go through each and everything in detail. So oversubscription, because it happens generally that the company needs 1,000 crores. They come with an IPO of 1,000 crores, but the company has received 5,000 crores. That means 5 times more than what the company needs. So in that case, they have to return the rest of it, but they can keep certain portion of the money. Okay, and we're going to talk about how much and for what purpose. Okay, otherwise they have to return the balance part and only up to the amount for which they have initially decided this is the money which you are going to raise, plus a 10% or something will be allowed for them to raise. Okay, so we'll talk about that. Then monitoring agency. So each company has to appoint a monitoring agency who is going to monitor that where the company, because before at the time when the company raises this thing, makes a prospectus and tells the people that we are going to raise 2,000 crores or 5,000 crores, where they are going to spend that money. So they give the objects of the issue. Are they going to pay the loan off, or they are going to pay loan and expand by buying new equipment, machinery, expand. They have to buy a building or something or whatever. Okay, so monitoring agency is going to see that till the last penny is spent, they are going to monitor and make a report and send it to the stock exchange, okay, and to the company. So generally the credit rating agencies like Crystal, ICRA, they are considered as monitoring agencies. So they are going to monitor the company that the money which have been collected have been put to use for the purpose it was intended to at the time the company went for an IPO or an FPO or any by way of public issue. Allotment procedure and basis. So whole process has been regulated. How the amount which has been received by the company, how it is going to get allotted. Because there are various kind of category of applicants. One can be individuals, public, they can be employees, okay, they can be the company's existing shareholders if they have been given a preference, okay, and it can be even anchor investors, those people who give money at the time, okay, at the start of the new company, or it can be the qualified institutional buyers, the big financial institutions, they also participate. Okay, so we're going to talk about that. So there are about, I think, 4 or 5 kind of categories, okay, or HNIs who are going to apply. Okay, so for each category there is a basis on which the shares would be allotted. Okay, allotment, refund, and interest. So that means if the company has got some extra money, okay, it needs to refund. If it has come through UPI or ASBA, then it's okay, the block will be removed. But if the money has physically moved to the company should return it back along with interest. So there is some time frame, okay, like for other investors where the money people are just giving a check, like institutional investors or some big investors, they are giving. So if they're not been given a full allotment, the balance needs to be refunded to them. It has to be refunded along with some kind of an interest within a stipulated time. Then release of subscription money. When the money comes to the company, it doesn't go into their account. Whenever shares applicants are making an issue, applications are depositing the money in the company's account, it comes to their escrow account. Okay, so there is an escrow account where the money is parked initially, and once the company has received full money, okay, then it is transferred to the company's account. Okay, fine. So we'll understand release of subscription money. So the merchant bankers will give a certificate that the company has complied with all the formalities, and now the company can be given this money. So once they give this certificate to the bankers will release that money to the company for their use. Okay. Price and price band. So companies have to decide about the price at which they are going to issue the shares. Okay, like when I was working with a company like Idea Cellular, way back in 2007, the company came with an IPO, and 10 rupee share was offered at 75 rupees, fixed price. Okay, no, there was a price band that time also. So company can either say this is my fixed price. At this, I'm going to issue share, or they're going to decide about a price band, say between say 65 to 75 rupees or 80 rupees, whatever, or any price band. Okay, fine. So there are some rules and regulations regarding price band. So then the shareholders will make a bid. So it's called book building process. Okay. So the process is like this, that either the company is issuing a fixed price. Okay. Like for example, an idea seller, suppose it came with a fixed price, the 10 rupee share was priced at 75. So they collected 65 rupees premium from the shareholders. Okay. Now who decides the premium? It's the company along with the merchant bankers. They work out that what should be the ideal price for offering shares to the public. Now, why the company would offer at a premium? So 10 rupee share will be offered at 75 rupees. So what's the logic behind that? ऐसा क्यों है that company is going to say that we are going to charge a premium? So what can be the reason? Anyone? Ananya? Anyone?
The desirability of the stock.
Huh?
So people who want the desirability, people want to really buy it, they are willing to pay extra above the price. In that case, there might be a set price.
No, sometimes the company is issuing at 200 rupees premium, 500 rupees premium, 1000 rupees premium, 60 rupees premium, 10 rupees premium. So the premium can differ. So on what basis the premium is, what can be the base? Can you think about that?
So one of the reasons would be that when you hire a merchant bank or an investment bank for an IPO, they do a lot of road shows where they go to institutional buyers and get an idea of the price they are willing to offer, and then the price band is defined. Okay. And the entire part of being charged a premium.
Look, that's not the right answer. I'll tell you the right answer. So look, आपने logic तो अच्छा दिया है, but the answer is not the right answer. Yes.
It could be the brand value.
Brand value. हाँ, थोड़ा हम नज़दीक पहुँच रहे हैं, but क्या होता है, for example, so suppose the company is already in existence, like Idea Cellular were already in existence, it was already in business for 10 years. Okay. Now, if the new shares holder come and they give money to the company, they will have equal rights on the existing assets and liabilities of the company. That time Idea was worth 10,000 crores. The assets they possessed. Okay. Or the net worth of the company was 10,000 crores. So if you bring new shareholders, if you bring new shareholders, now they will have proportionate rights on the existing assets of the company. So would you allow someone new to the company to become the equal right holder of those properties? No. So that means the valuation of the company has to be done. Okay. Suppose two people are doing business and the company is already 100 crores worth. If you are allowing new people into the business and making them partners, so you would not say that now you become, we become equal partners, or proportionately on the profit will be shared on a new ratio. It can't be like that. So that 100 crores which the value of the companies has to be contributed by the new prospective investors, so that now they can become the proportionate shareholders, right holders of the assets of the company. Fine. So the process is the company should do a valuation. What is the value of the company today? Like you might have heard, whenever a startup like the Byju's and all, of course they are not doing so well, or any company, when they bring new shareholders, they say the valuation of the company is now 100 billion or 20 billion or 10 billion. So the valuation of the company is done each time whenever the new investors joins in. So in this case, when a company is coming with an IPO, so you're bringing a lot of people inside, so you can't bring them at par. Okay, if you bring them the par, they will become the equal owners of whatever assets the company is already possessing on that day. Isn't it? You can't say that the new shareholders will have some, less rights. Okay. So valuation is done by a merchant banker. Okay. A merchant banker can do a valuation. And there is a valuation course, by the way. Have you done that? करा है? अभी valuation course करा है? तो valuation क्यों होती है? इसलिए तो होती है. Why we do valuation? One of the purpose is that you want to know what is the value of the company. How much premium you are going to charge to the shareholders, the prospective shareholders. Okay. So valuation can be done either through DCF mechanism or through a relative valuation like a PE ratio, or so many ratios are there. Okay. Fine. So we're going to talk about that in this course. So price and price band. Okay. So company is going to decide about the price, which will be based on, if suppose the company is starting from a scratch, then the company is going to offer 10 rupee share at 10 rupee value. The company doesn't own any asset. Okay. Okay. Or if the company is already having a business and they have developed a lot of expertise and a lot of work has been done when they bring in the investors, new investors, so the company will normally charge a premium, okay, to compensate them for the efforts they have put in the company. Okay, it can be either the brand or it can be in terms of the assets which they have acquired. So they will not allow the new shareholders to become the proportionate. They should have almost the same rights at equal to the existing shareholders. Is that okay? So that's why company come with decides about the price, which will have a premium, and sometimes they can decide about price band. Okay, because now the companies may not sometimes be sure, or the merchant bankers will say, okay, the price, because it's not like some company will have a fixed price. अब 10 रुपए का share है तो 100 rupees price. It can't be like that. So the merchant bankers say that your share should be in the range of say 100 to 120. So issue a price band between 100 to 120 and let people make a bid for it. Okay. So somebody will make at 100, somebody will make at 105, somebody will make at 120. So the whole process is called book building process. Okay, fine. And we are going to talk about that. How then the final price is decided. Okay. Once the company has received all the bids, so how the company is going to decide? Now it will be, for example, let's say just before even we have gone into it. So at a price which company is able to collect 100% of the money which they intended to collect, so the price, the highest price will become the issue price. Okay. Suppose it was 105, they got only 10%. Okay. 70% of the money was collected at say 110. Still the company has not got the money which they are looking for. Suppose 100% of the money has been collected at 115 bucks, so which means 115 will become the price at which ultimately the company may decide to issue the shares to the public. Okay. So we are going to talk about that, book building. Then promoters contribution. Okay. Promoters contribution is basically that promoters have to bring some money. The people who have started the company, okay, who have like, for example, Idea Cellular owned by Tatas, Birlas and AT&T at that time. Of course, now it is owned only by Birlas and Vodafone. Okay. So at that time there were 3 owners. So they have to chip in some money for each time they bring. So they should have at least 20% of the holding. Okay. 20% they should bring. Rest of the money they can collect from the public. Okay. This is a general law, but the law is little bit more elaborate and we're going to look into that later on. So this is also one of the very important piece of law which the company needs to follow. Okay. But for you people, it will not be discussed in detail, but a little bit. Okay. Because it's a very longish law and contains a lot of regulations. So this we have done. Okay. Minimum offer to public and reservation. So I told you that minimum offer to the public should be at least 25% should be offered to the public. So after the issue has been over, at least 25% should remain with the public. Okay. So if it falls below, then the company has to make sure that immediately it has to reach to 25%. Okay. Otherwise, the company needs to be delisted from the stock exchange. Then reservation. Now company can issue shares to employees. Okay. So there is some kind of a reservation which is allowed by the company to employees or the existing shareholders. Okay. Then company can reserve some portion. Yeah.
Does public reservation, does institutional buyers come under public?
No. It is only meant for employees or at the most the existing shareholders. Okay. Let's talk about it. Will be done in a great detail. Just the bullet points we are talking about. We are trying to understand what this law contains. Okay. Then the law is about 500 pages. So I've just put them into just few bullets here. So then allocation in net offer. How much money will each category of investor will get? How much money will go to the retail investors? Now retail investors are the people, general public. So they are allowed to participate only up to maximum up to 2 lakh rupees. Okay. So there's the slide coming there. So a retail investor, people like you and me, we can make maximum application up to 2 lakh rupees. Okay. Fine. So not beyond that, or we can even apply for less. It's not guaranteed that we'll get the money, because if the share issue is subscribed say 10 times, 20 times, then some proportionate method is allowed. Okay, fine. So allocation in net offer. Normally, there is a quota for retail investors, like 25%, 30%, 50%, depending on what the company is. So we're going to talk about that, depending upon what. So we're going to do. And some portion is for, say, big investors, like qualified institutional buyers. There are about some 13 institutions which have been classified as QIBs. Okay, so they have to be allotted some share. It goes up to 75% also. Now, in case the company is a loss-making company is not making profit at all, like in Zomato or IPO, before they came in IPO. So they were allowed to go to the public and tap money. But it was said that the money has to be raised, 75% money has to be raised from QIBs. If they are giving money to the company, then the public may find that it's okay if such a big institutions are applying and they are giving money, so we can also make a play. So only 25% will be reserved for public, general public, and for other categories. So we're going to talk about that. So how each category has to be allotted, so there is a rules in the regulations. Okay. Then exit opportunity to dissenting shareholders. Now once the company has collected the money, okay, and company has decided to spend money not according to the objects which they have declared at the time of raising the money by way of prospectus, so immediately within certain time frame, the shareholders can raise a red flag and they'll say, return our money, because we have not used the money for the purpose for which it was raised. So this is an exit opportunity given to the dissenting shareholders. Okay. Then the rights issue which I talked about, as per Companies Act, the first right belongs to the equity share, already equity shareholders. Okay. If they renounce their right, then they can go for an FPO. Then preferential issue, only select few. Okay, we'll talk about that. Which companies are allowed for preferential issue? Qualified institutional placement. Okay, so the company can issue shares to the QIBs only. The 13 companies. Okay, 13 entities. We're going to talk about that very shortly. SME exchange. So immediately after these bullet points are going, so I'm going to cover some more points which I am referring to, like QIBs and all. I'll be going to cover SME exchange. So in India, we have not only one stock exchange, we have 2 or 3 stock exchanges. People are not aware of that. Normally we think that there is only a national stock exchange or a Bombay stock. So that's called the main board. All the big companies, they are listed on the main board. There is a SME exchange also, where only small companies and medium enterprise, they get listed. Okay, and because they can't compete with the main companies, so they are listed on SME. Okay, so there is an SME exchange. So we're going to talk about that. Then listing pursuant to an IPO at IGP. So there is an IGP, which is called an innovative growth. Innovative growth something, IGP, a platform, innovative growth platform. So only companies who are startups, they are allowed to get listed the IPO for an IGP platform. So it's like another platform in the stock exchange. Like we have an SME, main board, and IGP. Okay. So IGP is a platform created by stock exchanges like BSE and NSE, designed to facilitate the listing of innovative high growth companies such as startups with a focus on sectors like technology, innovation, and digital businesses. It allows smaller and high potential companies to access public markets with more relaxed regulatory requirements compared to the main board listing. Okay. So they are allowed certain kind of benefits, because though they are startups and they are into some sectors like technology, innovations, so they can get listed themselves under an IGP platform. Okay, but the IGP has not taken off so much. Okay, so they get listed maybe on the main board. We'll just see what is this thing. So we'll go to a site and find out where they are getting listed now. So SR equity shares, these are special equity shares. So some each shareholder has one, depending on his voting, depending on number of shares, he is allowed to vote in a meeting. Okay, for one, now here there are certain promoters or certain people who will get more voting rights, more in proportion than others. Okay, like a person may have 10 voting rights, he can his vote will be counted as 10 times than the others. It's called special SR voting rights, special rights. Now it is only given to companies where if that person leaves the company, it is going to make a big difference to the company. Okay, because he is a man who is behind the technology and setting up the company. He is a promoter. It should be a small company. It can't be companies like Reliance and others, Ambani's. It has to be a company of certain net worth. Okay, where company, the person has, that person who started the company, if he leaves, the company can fall into a trap, or it can be in losses. So it can be given, this right can be given to only those kinds of person, and it is given only for a certain period like 5 years, okay, or thereabout. Special SR equity shares. So it's very important, this thing, and there can be a question in your take home paper regarding SR equity shares. Then IGP we are already done. Fast track and IPO, because the whole process involves a lot of formalities. You make a prospectus, you make a draft offer, then you put it to the Sebi. We are going to understand that, and then it has to be even declared to the public before your company can raise money. So it has to be shared with the public, so they can come with some observations about. So once all the observations of the public is met, Sebi regulations are met, and all the road shows we're talking about this thing. So all that have been conducted. So everything has been conducted. After that only the company can come with an IPO. So there is a fast track IPO where the company is already an existing company, okay, and they have a very good compliance record in terms of meeting all the regulations, and so they can be allowed to raise the capital bypassing certain regulations, okay. So it's called fast track IPO. Then a QIB, qualified institutional buyers, okay. So we are going to talk about that. Who are the QIBs? There are 13 entities in India who have been classified as QIB, and they need to be registered with Sebi to get them classified as QIBs. Okay, so they have a financial muscle power, and they know about they have all that kind of a knowledge to analyze an IPO. Okay, and they are allowed to participate. Okay, and in a case of a loss-making company, if they are not meeting criteria, then at least 75% of the money should be collected from them. Then incentive not allowed. No incentive should be allowed to anyone. Okay, apart from only the commission which is given to the brokers. Apart from that normal commission, which is, there is a tag, there is a regulation there, but no incentives. That a free a new car will be given if you apply for so many shares or something like that. You can't. Okay, or some coupons will be given for lunch coupon.
Something like which does not encourage the buyers to like.
No incentive should be given. Okay, it should be purely on the merit basis on the company's existing performance or future this thing or whatever. They are going only on the valuation that the company is good to put the money. So we'll have a small break just after I cover the bullet points, and I think it's so period of subscription. So how long the issue will remain open. So I think the maximum time is 10 days. For 10 days, the company can wait and ask people to keep applying. Okay. Normally the third day, normally it's closed because they receive a response. But sometimes there's a lukewarm response, so they can go up to 10 days. Then advertisement. So there has to be a pre-advertisement and post-advertisement. The advertisement before the company goes to an IPO, and then a company has to make a advertisement after the IPO has been successful or not successful, where they are going to mention how many shares they have, how much money they have received, how the shares have been allotted, all that stuff after the post issue. And pre-issue they talk about the company's plans and other things. Okay, so pre-issue and post-issue we are going to talk about that. Restriction on further capital issue. So if the company has raised the money, then there is a cooling period. Okay, they can't go to the public immediately. Okay, the banks are allowed to raise money immediately, but not all the companies. Okay, so now we are going to have a break, 11:42. So we have a 15 minutes or 12 o'clock we'll meet. Any questions? So after that, we are going to talk about, just before we